Welcome back to the Deep Dive. Today, we are getting into a really fascinating, maybe even contentious topic in crypto right now. We're doing a full breakdown of what's shaping the future price of the Pi Network's PI token.
Yeah, this one's interesting. You've got this huge grassroots community, right? It's kind of like crypto for your phone. But then there are these, well, pretty serious technical challenges, too. Our sources are pretty deep on this one. Everything from the core tech hurdles like migration all the way out to, how things like Fed policy are playing a role.
Exactly. And our mission today is simple, really. We want to take all these different pieces, the tech specs, the adoption numbers, the big global economic trends, and kind of synthesize it. Give you a clear shortcut to understanding what's really driving PI's value, looking ahead to 2025 and beyond.
So we'll start kind of inside the network first. Look at the basics, the immediate challenges the project's facing. Then we'll zoom out, way out, and look at the bigger picture, the macroeconomic environment, which honestly could have just as much impact on the price.
Okay, let's lay the groundwork. Pi Network kicked off back in, I think, 2019. Stanford PhDs behind it. The whole idea was making crypto accessible, right? Just press a button on your phone once a day. And it definitely worked in terms of getting users. The base is massive. But like you said, the tech reality,
Yeah.
that's what really hits the valuation.
Precisely. And the single biggest thing hanging over everything right now, it's successfully finishing that migration to the open mainnet. That's like the foundation. It absolutely has to happen.
And the numbers around supply are pretty wild. They really tell a story here. So as of September 2025, we've got over 13 million users migrated. Total supply is 7.4 billion PI.
Right.
But here's the kicker. 5.2 billion of those are locked up. Locked. That leaves only about 2.2 billion actually circulating right now.
And that supply tightness, that's the key dynamic to watch. The vast majority of the tokens just aren't available. So the part that is trading, that 2.2 billion, it's incredibly sensitive to any market shifts. That 5.2 billion locked up, it's like potential energy, maybe volatility waiting to be released.
Okay, so if the open mainnet is goal number one, what's the actual holdup? What's stopping all the users from just moving over quickly?
The immediate bottleneck seems to be the know your customer process, the KYC verification. There have been ongoing issues there. And those problems are creating a real slowdown in getting everyone fully transitioned onto the mainnet.
Right. I get that it slows things down. But why does that impact investor confidence so much? Is it just the delay?
It's more about the uncertainty it creates around the final supply. If the team can't reliably KYC everyone who mined Pi, well, how many of those 5.2 billion locked tokens will actually hit the market eventually, and when? Analysts can't model that properly, and that kind of fundamental supply uncertainty is really damaging for investor confidence.
Supply uncertainty. And our sources also mentioned a risk around centralization. That sounds a bit odd for a crypto project, doesn't it? What exactly is the core team doing that raises that concern?
Well, right now, the core team still verifies all the mainnet validators. They have a significant amount of control over that process. Now, maybe that's for stability in the early stages, but it's not really decentralized yet. And that lack of true decentralization, that's a major turnoff for big institutional investors. They need to see that cryptographic decentralization before they bring in serious capital.
Yeah, the institutional barrier is huge. Okay, let's pivot a bit. There was some good news recently on the transparency side, the open source code.
Absolutely. That was a big milestone. The code base hit 90% open source back in August 2025, and the word is it should hit 100% this month, September. Psychologically and practically, this is critical.
Why is hitting that 100% mark such a big deal? Specifically.
Well, first off, it's basically a non-starter for getting listed on major exchanges. If your code isn't open, they just won't list you. But also, it's about building trust back with the community. There have been, let's say, challenges with meeting deadlines in the past, so actually hitting this transparency milestone shows they can execute. It opens the door to that wider market access, which, ultimately feeds back into the potential price.
Okay, so we've covered the tech infrastructure, the supply issues, but a token's only valuable if people actually use it, right? Utility drives everything. Is there a real economy being built around PI yet?
It's definitely still building, more like an acceleration phase, but yes, there's activity. They're pushing development hard. Look at the Pi hackathon that's running now through mid-October. They've got a 160,000 PI token prize pool. That's serious incentive to get developers building apps.
And what kinds of apps are we actually seeing? Is it just experimental stuff, or is there real adoption happening?
We're seeing over 80 dApps emerge, focused on areas you'd expect for a digital economy. E-commerce is one, education, some governance tools, and financial services. It's moving beyond just tech demos. They seem to be trying to build the actual infrastructure for exchange.
And the proof is in people actually spending it, I guess. Are payments happening?
Yeah, payments are growing, especially seeing traction in some Asian markets. Community events like PiFest help demonstrate that. And there are specific apps now, like Booster. People are using PI through apps like that to top up their mobile phones or buy gift cards. That's kind of the ultimate validation, isn't it? Seeing merchants accept it for everyday things, it supports the whole original idea of Pi as a payment medium.
Okay, so that covers the internal stuff, the homework the Pi team needs to do. But then there are these massive external forces they can't control, like the Federal Reserve. Let's zoom out now to those macro factors.
Yeah, you really can't ignore the Fed. Its policy probably has the single biggest macroeconomic influence on PI's price. Crypto, especially something like PI seen as high growth, high risk, is super sensitive to the cost of money, the cost of capital.
And the key data point recently, according to our sources, September 2025, the Fed actually cut rates, 25 basis points. That brought the target range down to 4.25%, 4.5%.
Exactly. And the market reaction was pretty immediate. We saw about $1.9 billion flow into crypto investment products shortly after. So what here is key? Lower interest rates make borrowing cheaper. It pushes investors to look for higher returns, making riskier assets like PI seem more attractive compared to safer things like bonds or just savings.
But then you had the US dollar index, the DXY, which kind of works in the opposite direction. Explain that negative correlation.
Right. Think of the DXY as a measure of the dollar's strength against other major world currencies. When the DXY goes up, it usually means global investors are nervous. They're seeking safety in the US dollar. A strong dollar tends to pull money out of riskier assets. So yeah, a rising DXY usually puts downward pressure on things like PI as capital flows away from crypto.
Okay, now inflation. This one's tricky because our sources say it has sort of a two-sided effect on PI.
It absolutely does. It's complex. On one hand, really high inflation can actually be good for PI, theoretically. Why? Because people might see their regular money losing value and look for alternatives, maybe viewing crypto like PI as a potential hedge, a different store of value. That's the bull case.
But the other side of the coin is how central banks react, isn't it?
Precisely. If inflation gets too high, central banks usually step in and raise interest rates to cool things down. And as you just said, rising interest rates, that tends to trigger a big risk-off move in markets globally. Investors pull back from risky things. So that's overwhelmingly negative for PI. You have to watch the response to inflation, not just the rate itself.
And the connections don't end there. What about gold? Gold surged massively in 2025, like 45%, while crypto felt some pressure. How does PI relate to gold?
Yeah, the gold relationship is interesting. It's not simple. In a sudden market crash, maybe everything falls together initially, so you might see a brief positive correlation. But longer term, they represent opposite investment theses, really. PI is about potential high growth, high risk. Gold is about preserving capital, safety. They generally compete for investor dollars based on the overall market mood, opposing forces mostly.
What about oil? Does that impact P much given its mobile mining approach isn't as energy intensive as, say, Bitcoin?
It's less direct than for proof-of-work coins, sure, but it's still relevant. Oil prices feed into general energy costs, which affect running any large network infrastructure. More importantly, though, high oil prices can signal wider economic trouble, maybe inflation concerns, which feeds back into that whole macro risk sentiment we discussed. It affects the overall environment PI operates in.
And the last big external factor, geopolitical instability, the ultimate wild card.
Pretty much. Geopolitical tensions just amplify volatility everywhere, especially in crypto. A major crisis could cause a huge sell-off as people flee risky assets. But conversely, if a crisis destabilizes traditional currencies or financial systems, it could actually increase demand for decentralized alternatives like PI. The only certainty is that it makes markets move sharply, often in ways that are hard to predict.
Okay, let's try to pull all these threads together. The
Right.
bottom line, price projections. And wow, the range analysts are giving is huge. It really shows the uncertainty.
It really does. You've got the more conservative end, looking at forecasts from places like CoinCodex or priceprediction.net. They're generally putting the average price for 2025, maybe into 2026, pretty low, think somewhere between roughly $11 and 26 and 58 centsibles. That range reflects the reality today. The technical hurdles still exist. The KYC backlog is real.
But if they manage to fix those things, if they complete the open source code, sort out KYC quickly, get listed on a big exchange.
Then the picture changes dramatically. The optimistic scenarios, assuming successful migration and real utility taking off, they see PI potentially reaching $1.60 by the end of 2025. Some analysts are even talking about potential for 200% growth if that ecosystem really starts firing on all cylinders. That huge gap, between like 25 cents and $1.60, that tells you almost everything about how much uncertainty is tied directly to nailing those technical and adoption milestones, especially KYC.
And that uncertainty gets magnified by what you call the biggest internal risk,
Right.
supply shock from unlocking tokens.
Exactly. That unlocking schedule is always lurking. We saw 160 million tokens unlock back in August 2025. There's another 170 million scheduled for December 2025. Imagine if the KYC issues suddenly get resolved and those tokens become available. That sudden flood of supply could potentially overwhelm demand, pushing the price down, even if the broader macro environment is looking positive at that moment. It's a key risk factor.
So boiling it all down for the listener, what's the combination? What determines if we see that, say, 25-cent floor or the $1.60 potential ceiling?
I think it really comes down to three things happening together, working in sync. One, successfully completing that technical foundation, the full mainnet migration. Two, rapid, measurable growth in actual use cases, real utility with merchants adopting it. And three, crucially, overcoming those current roadblocks, the KYC delays, the centralization concerns, because that's what unlocks the potential for wider exchange listings and institutional interest.
This has been incredibly insightful, really breaking down all the layers. Let's wrap up by giving our listener a clear checklist. What should they be watching closely right now?
Okay, four key areas to keep tabs on. First, watch for clear signs that those KYC problems are being solved and the open mainnet migration is finally complete. That's number one. Second, look for news of successful listings on major crypto exchanges. That would be a huge validation, especially after the open source completion. Third, keep an eye on the ecosystem itself. Is merchant adoption actually speeding up? Are people using those dApp apps, or is development stalling?
And fourth, you just can't ignore the outside world. Keep monitoring central bank decisions, especially on interest rates, and watch the geopolitical landscape. Any major shifts there could cause sudden, extreme swings in the crypto market, including PI.
Absolutely. You need to track all these things closely. And just be prepared for potentially high volatility. This is a really critical make or break period for the Pi network.
So considering everything we've discussed, especially that huge difference between the locked tokens 5.2 billion and the circulating ones 2.2 billion, here's the final thought for you, the listener. Which factor do you think will ultimately have the more explosive impact on that circulating supply in the coming months? Will it be the internal factor, the technical completion, potentially unlocking billions of tokens? Or will it be an external shock, a major shift in Fed policy or the global economy? That's the key tension to think about. Thanks for diving deep with us today.